If you want to own the future of artificial intelligence in 2026, two names dominate the entire conversation: Nvidia and Tesla. But here's the reality. The landscape has completely shifted. Nvidia is no longer just selling picks and shovels for the AI gold rush. They are now building the agents that will actually do the mining. Meanwhile, Tesla is fighting to prove it's not just a car company, but the leader in real-world AI, aiming for humanoid AGI within this decade. Today, we're breaking down latest earnings, March 2026 AI announcements, valuations, and the final verdict on which stock is the true AI king. Let's get straight into it. Let's start with how the market is actually pricing these two companies right now, as of late March 2026. Nvidia is currently trading with a market capitalization of roughly $4.3 to $4.5 trillion, making it one of the most valuable companies in the world. Its price-to-earnings ratio sits at around 45 times earnings. Tesla, on the other hand, has a market cap of about $1.4 to $1.5 trillion, but its valuation tells a completely different story. Tesla is trading at a PE ratio of roughly 280 to 300 times earnings. Now here's the key takeaway. Nvidia's valuation is built on real, massive profits being generated today. At around 36 times earnings, you are paying a premium, but it is backed by explosive growth and dominant margins. Tesla, however, is priced almost entirely on future expectations. At over 350 times earnings, the market is not valuing Tesla as a car company. It is pricing in a future where Tesla successfully delivers robotaxis, autonomous fleets, and humanoid robots at scale. So the reality is simple. If Tesla remains primarily an automaker, it is massively overvalued. But if Tesla solves real-world AI, autonomy, and robotics, then today's valuation could actually turn out to be cheap. Let's talk numbers, because this is where hype meets reality, and the gap between Nvidia and Tesla becomes crystal clear. First, Nvidia earnings. Quarterly revenue, $68.1 billion, up 73% year over year. Data center revenue alone, $62.3 billion, the backbone of every major AI application today. Gross margin, 75%. Yes, software-level margins on hardware. Every AI giant, Microsoft, Amazon, Google, is paying Nvidia for compute. This isn't speculation. These are real profits already in the bank. EPS, GAAP $1.76, non-GAAP $1.62. Bottom line, Nvidia isn't just riding the AI wave, it's printing cash while everyone else spends. Now let's look at Tesla earnings. Quarterly revenue, $24.9 billion. EPS non-GAAP about 50 cents, gross margin 20%. Energy generation and storage revenue grew roughly 26% year over year, but let's be honest, Tesla is still a car company first. AI ambitions, Optimus, full self-driving, and the AI6 chip are exciting, but right now they contribute essentially zero to revenue. Cars and energy are paying for Tesla's future bets. Tesla is a capital-intensive builder, burning cash to fund AI dreams, the kind of gamble that could pay off big or fail spectacularly. When you put both companies side by side, Nvidia equals cash machine, Tesla equals future factory. Nvidia is winning now, Tesla is still writing the playbook. Margins highlight the contrast. Nvidia keeps $75 for every $100 of revenue before operating costs. Tesla keeps $20 for every $100 of revenue before operating costs. And cash flow? Nvidia is printing free cash, giving flexibility for reinvestment or shareholder rewards. Tesla is still dependent on vehicle profits or capital raises. Nvidia equals profit machine, low execution risk. Tesla equals visionary gamble, high execution risk. If you're playing for certainty, Nvidia is the pick. If you're chasing moonshot potential, Tesla is the bet. Just know the odds are long. Both Nvidia and Tesla made huge announcements in March 2026. The announcements didn't just bring new products, it brought new meaning for what AI actually is in the market. Nvidia, the agentic AI and infrastructure dominance. The big news of March 2026 was Nvidia GTC 2026 coverage highlights, Nvidia's annual AI conference in San Jose, where CEO Jensen Huang spelled out the company's next chapter. A few key shifts. AI is no longer about bigger models only, it's about agentic systems that plan, reason, and do tasks autonomously. Nvidia officially rolled out its Agent Toolkit and OpenShell framework, tools that let enterprises build and run autonomous AI agents integrated with real workflows. At the show, Nvidia also pushed next-gen open model families that power reasoning and agentic workflows across industries, from enterprise automation to physical AI. Behind all this is a larger theme. Nvidia is positioning itself not just as a chip maker, but as the company that operates the AI economy, infrastructure, agents, software, and execution engines, all tied together. This isn't hype, it's a strategic shift from selling hardware only to selling AI platforms plus full-stack execution. Think of it like moving from selling engines to running the entire transportation network. Tesla, physical AI, robots, chips, and terafab. Tesla's AI narrative isn't just software, it's tied to real-world machines, and by March 2026, that story had two major public touchpoints. 1. AI-6 self-driving chip pipeline. Elon Musk confirmed that Tesla is developing the next generation of full self-driving AI chips, with AI-6 targeted for a later 2026 tape-out. But hardware timelines matter. Beyond teasing specs, AI-6 isn't powering large-scale revenue yet. It's still in development and years away from mass deployment. 2. Terafab Semiconductor Factory Project. Tesla, SpaceX, and xAI publicized plans to build a massive vertically integrated semiconductor fabrication facility capable of producing 1 trillion watts of AI compute capacity per year. Terafab is strategic but early and enormous in cost and complexity. Analysts estimate tens of billions in investment and a long multi-year build-out before volume production. So, what does this actually mean? Nvidia's AI strategy is already in motion today. The company is shipping tools, frameworks, agent infrastructures, and open models. Enterprises are adopting them now. There's a momentum curve, not just a promise. Tesla's AI strategy is still largely in the future build-up phase. Full self-driving remains at Level 2 supervised autonomy in vehicles, meaning humans still must monitor the system, and true Level 5 autonomy has not been delivered. Robotics, or Optimus, and custom AI silicon are real initiatives, but as of early 2026, they haven't yet broken out as core revenue streams. They're investments, not cash generators. That's not to dismiss potential, just to ground it in where the real value is today. Here's the blunt reality. Nvidia owns the digital AI economy. Agents, infrastructure, open models, enterprise tools, these are monetized and operating now. Nvidia is already capturing demand. Tesla is chasing the physical AI economy. Cars, autonomy, robots, chips, these are future revenue engines still under development with long horizons and execution risk. Both visions are massive, but they're not on the same timeline. One is already winning monetization today. The other has vision, but still must prove execution. Let's break it down cleanly and really understand how Nvidia and Tesla compare, not in hype terms, but in business reality. Look, both Nvidia and Tesla are now viewed by the market as AI plays, but that's where most of the similarities stop. Both companies are heavily AI-focused narratives. Markets see them as key players in the next industrial revolution. Both invest in custom silicon and computing architectures, Nvidia with GPUs and AI platforms, Tesla with FSD chips and future hardware like AI-6. Both have visionary leadership and dominate tech headlines. Both are pursuing the idea of physical AI, where software enables machines that interact with the real world. But that's where the similarity ends and the divergence begins. Let's unpack the real differences that define the risks, business models, and execution timelines for these two giants. 1. Business model. Nvidia to B2B infrastructure dominance. Nvidia doesn't sell finished products to consumers. It designs chips and platforms that other companies integrate into their AI systems. This fabless model means it can focus on design while partners manufacture, and it keeps margins extremely high. Tesla to B2C product maker. Tesla makes and sells electric vehicles, energy products, and eventually robots. Those products must work and scale at consumer prices, which is a harder, more capital-intensive business. So, Nvidia makes money now. Tesla hopes to make money from AI in the future. 2. Revenue model. Nvidia monetizing now. Almost 90% of Nvidia's revenue comes from data center AI infrastructure, and it just reported a record $215.9 billion in total 2026 revenue, driven almost entirely by strong demand for AI compute. Hardware like GPUs, as well as software and platform services, already generate real, stable income today. Tesla future AI monetization. Tesla's current revenue is dominated by vehicles and energy products, and its most hyped AI ambitions, robotaxis, Optimus robots, and FSD full autonomy, aren't major revenue streams yet. Those are long-term bets that still need proof of execution, regulation, and deployment at scale. So, Nvidia makes money now. Tesla hopes to make money from AI in the future. 3. Risk profile. Nvidia execution already proven. Data center AI demand continues to grow, and Nvidia is the default provider for hyperscalers, enterprises, and cloud services. Investments here are less speculative, they're happening. The physical AI part, like autonomy and robotics, is still a small percentage of revenue today, less than 3% of overall revenue, but it exists on the platform and can grow without Nvidia needing to build finished products. Tesla, high execution risk. Tesla's future hinges on delivering fully autonomous vehicles, profitable robotaxi services, massive chip production, and humanoid robots, all of which are not yet proven at scale. Regulatory approvals, technical validation, and large-scale adoption are major unknowns. So, Nvidia's growth is baked in revenue today. Tesla's growth is theoretical until the AI products prove themselves. Here are the simple strategic truths. Nvidia is building the infrastructure layer, the nervous system of AI, and selling it everywhere. Tesla is building AI products that must be adopted, regulated, and monetized at scale. One gets paid for enabling AI, the other hopes to get paid because its products become AI leaders. That's a very different path. Here are the simple strategic truths. Nvidia is building the infrastructure layer, the nervous system of AI, and selling it everywhere. Tesla is building AI products that must be adopted, regulated, and monetized at scale. One gets paid for enabling AI, the other hopes to get paid because its products become AI leaders. That's a very different path. Some analysts even point out that AI's biggest economic wins will eventually come from machines that interact with the physical world, and that both Nvidia and Tesla are key in that space, but they're playing very different roles. This sets up a broad ecosystem where Nvidia could power autonomy for many vehicle brands, industrial robots, and service fleets. Tesla must bet that its own products win, be it robotaxis or humanoid services. Bottom line, this is my take on these two stocks. Nvidia equals platform play, enables AI everywhere, monetizes now. Tesla equals product play. AI success depends on scaling its own machines, high upside, high risk. And that difference is the engine behind how the market prices these companies, and why one looks like stability while the other looks like a high-stakes bet. So here's the real answer. No hype, no bias, just reality. Let's separate what's priced, what's proven, and what's truly likely. Nvidia is the king of AI infrastructure. Nvidia isn't just a chip company, it's the backbone of virtually every major AI application on Earth. Its data center GPUs and AI stack dominate global cloud providers and enterprise AI builders, and firms like Tesla's SpaceX AI and Tesla itself have publicly said they'll continue buying Nvidia chips at scale, even as Tesla pursues its own silicon. Here's what makes Nvidia the safer core holding. Market position, near unrivaled share in AI compute hardware. Earnings power, record revenue and profitability from AI infrastructure, ecosystem moat, partners and customers entrenched in Nvidia's platforms, execution risk, lower relative to frontier tech bets. Investors and analysts are even projecting multi-year demand that could support enormous revenue in the AI era, although the market sometimes underprices this because Nvidia's scale means growth becomes harder to outperform expectations. Tesla is the next AI moonshot. For Tesla, by design, it's not a predictable infrastructure play. It's a bet on future disruptive technologies. Robotaxi vision, the largest part of the AI story and Tesla's valuation, is its promise of autonomous fleets and robotaxis. But Level 5 autonomy has not yet been delivered at scale, and regulators are still shaping how and when these systems are legally permitted. Robotics ambitions, Optimus and other robotics initiatives are exciting, but they're early stage and not yet major revenue drivers. Terafab and chips. Tesla recently announced the massive Terafab semiconductor project with SpaceX and xAI, a bold attempt to vertically integrate AI compute production, but it won't meaningfully produce volumes until late 2027 or beyond, and it's a huge capital burden. Tesla's path has potentially enormous upside, but it comes with execution risk, technological uncertainty, and regulatory hurdles. If you want certainty, Nvidia wins. Proven demand, monetization today, deep ecosystem integration. If you want exponential upside, Tesla is the gamble. Big possible payoff, long timeline, execution uncertainty. It's not about which story sounds cooler, it's about what's already monetized versus what's still a promise. Nvidia's infrastructure dominance is why investors see Nvidia as a safer core holding. If you're building a core tech position that you sleep well with, Nvidia is the safer choice. If you're allocating a small slice of capital to a visionary bet, Tesla might fit that role, but only as a fraction, not the foundation. Personally, I have sold out Tesla and redeployed to fund Microsoft and ServiceNow during the software crash and have been buying more Nvidia shares recently. Let me know what your thoughts are in the comments below. That's it for today's video. If you like content like this, please support me by hitting the like button and subscribe to this channel. See you in my next diary.